Welcome to our deep dive on building generational wealth with just $100 a month. In this video, we will explore how to use custodial accounts like UGMA and UTMA and how to overcome mutual fund minimums by leveraging proprietary total market index funds and fractional share ETFs. We will proceed step by step, and by the end, you will have a simple, repeatable plan to keep every dollar working while minimizing cash drag. Here's today's roadmap. First, we will clarify what custodial accounts are and why they are powerful for generational wealth. Next, we will identify the common obstacle of high minimums on popular index mutual funds. Then, we will reveal two practical solutions designed for small, consistent investors. After that, we will walk through the setup steps with a straightforward checklist. Finally, we will reinforce your understanding with visual diagrams and short quizzes. The core idea is simple yet powerful. Automate small, consistent contributions into a broadly diversified, low-cost index so that every dollar is invested immediately. By eliminating barriers such as mutual fund minimums and avoiding idle cash, you allow compounding to work for decades, especially inside a custodial account for a young beneficiary. Let's begin with the vehicle. A custodial account, whether UGMA or UTMA, is an account managed by an adult custodian for a minor beneficiary. Contributions are irrevocable and become the property of the child, which is why it is important to plan gifting carefully. Because these accounts can hold investments for many years before the child reaches the age of majority, they are ideal for harnessing long-term compounding. However, there can be tax implications, such as the so-called kiddie tax. Therefore, it is prudent to keep accurate records and consult a qualified tax professional where needed. This timeline illustrates the long arc of consistent contributions. In the first year, the priority is simply to start and automate. By year 5, staying disciplined through market ups and downs matters more than trying to time entries. By year 10, reinvesting dividends enhances compounding. Around year 18, some families consider education needs, while others choose to let the investment continue. Beyond year 25, compounding has had the longest runway. Remember, the numbers are hypothetical and actual returns will vary. Here is the roadblock. Many well-known S&P 500 mutual funds impose initial minimums of $1,000 or more. For investors aiming to contribute $100 per month, that hurdle can delay investing and create idle cash, which is the opposite of what you want when you are trying to maximize compounding. The first solution is to use your brokerage's own total stock market index mutual fund. Many brokerages waive initial minimums if you set up recurring, automated investments, which allows your full $100 to be invested immediately. This is highly effective at minimizing cash drag. Moreover, a total market fund typically includes large, mid, and small capitalization companies, resulting in broader diversification than an S&P 500 fund that focuses on large caps. The second solution is to use fractional share exchange-traded funds. By selecting a low-cost, broad market ETF that supports fractional purchases, you can invest an exact dollar amount, such as $100, regardless of the current share price. This design ensures that no cash sits idle. In addition, ETFs often carry very low expense ratios and can be traded flexibly during market hours. This decision tree helps you select the practical route. If your brokerage offers a proprietary total market mutual fund with minimums waived for automation, choose that and set $100 per month with dividend reinvestment. If not, check whether fractional share ETFs are supported, and if so, use a low-cost total market ETF and set automated investments with dividend reinvestment if available. If neither is supported, consider moving to a brokerage that offers at least one of these features. Here are the steps to implement. First, open a custodial UGMA or UTMA account for the beneficiary. Second, connect your bank and enable automatic transfers. Third, choose a broad, low-cost total market index product, either a mutual fund or an ETF. Fourth, if you selected a mutual fund, confirm that the brokerage waives the minimum with automated investments. Fifth, if you selected an ETF, confirm fractional share support and enable dividend reinvestment. Sixth, schedule a recurring $100 purchase on a consistent monthly date. Seventh, document your approach in a brief investment policy statement to maintain discipline. Finally, review quarterly to confirm contributions are posting and to avoid drifting from your plan. This table summarizes both options. The total market mutual fund often waives minimums when you set automation, offers broad diversification, executes at the daily net asset value, and typically carries a low expense ratio. The fractional share ETF path provides similar diversification and low costs while allowing intraday execution. In either case, dollar-based purchases reduce idle cash and keep the plan simple. On the left, cash drag occurs when money sits uninvested while you wait to meet minimums or time purchases, which reduces compounding potential. On the right, being fully invested through automation or fractional shares ensures each $100 contribution is promptly deployed, maximizing time in the market and the effect of compounding. Quiz time. Which action most directly minimizes cash drag for a $100 per month plan? Option A, waiting to hit a $1,000 mutual fund minimum. Option B, automating buys into a proprietary total market mutual fund with minimums waived. Option C, manually timing purchases quarterly. Option D, parking cash until share prices drop. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is automating purchases into a proprietary total market mutual fund where minimums are waived. This process invests your entire contribution immediately and avoids idle balances, which directly combats cash drag. Second quiz. Why might a total stock market index be a superior long-term vehicle than the S&P 500? Option A, it guarantees higher returns. Option B, it has broader market coverage beyond large-cap stocks. Option C, it eliminates all risk. Option D, it always has lower fees. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is that a total stock market index has broader coverage than the S&P 500 by including mid and small capitalization companies. This increases diversification across the market, which can be advantageous over long horizons. It does not guarantee returns, eliminate risk, or always have lower fees. This mind map places automated dollar cost averaging at the center. It branches into consistency because scheduled buys prevent missed months. No idle cash because dollar-based purchases invest the full amount. Discipline because you follow a documented process. Compounding because time in the market matters more than timing. And simplicity because the plan is easy to maintain. These rules of thumb reinforce the process. Automate contributions and purchases, prefer broad and low-cost total market exposure, reinvest dividends to enhance compounding, review quarterly without engaging in market timing, and minimize all forms of friction, including fees and idle cash. This pie chart is conceptual, illustrating the target state where nearly the entire $100 contribution is invested immediately. A very small slice accounts for unavoidable frictions, such as fees or slippage. And the goal is to drive idle cash to effectively zero by using automation or fractional shares. Before we conclude, an important disclaimer. This content is for educational purposes only and does not constitute financial, tax, or legal advice. Investing involves risk, including the possible loss of principal. Any returns mentioned are hypothetical examples and not guarantees. Consult a qualified professional regarding your specific circumstances. This roadmap summarizes the action plan. Step 1 is to open the custodial account. Step 2 is to link funding and automate transfers. Step 3 is to choose a total market product suited to your brokerage's strengths. Step 4 is to set a recurring $100 investment and enable dividend reinvestment. Step 5 is to review quarterly and maintain discipline. To wrap up, a custodial account provides a powerful time horizon for compounding. High minimums should not derail your $100 monthly plans. Work around them by using either a total market mutual fund with automated minimum waivers or a fractional share ETF. Automate contributions, reinvest dividends, and minimize idle cash to maximize impact. Thanks for watching. If you found this helpful, please like the video, share it with someone who is building for the next generation, and subscribe for more practical wealth building playbooks. In the comments, let us know your setup, your brokerage choice, and any questions you want us to cover next.